If you're looking for passive income that allows you to build a flourishing bank deposit, then investment is the way to go. Benjamin Graham may have all the answers you need. Who is Benjamin Graham, you might ask? I'm sure you've heard of Warren Buffett, one of the richest people in the world. And I'm sure you already know that investing in the right places at the right times helped him reach his financial goals. Well, Warren Buffett once said that if he hadn't found The Intelligent Investor, written by Benjamin Graham when he was 19 in the year 1949, he might have ended up leading a much less financially fruitful life. And today, we'll show you the opposite with The Intelligent Investor book summary. So, with one of our world's greatest financial investors backing the man, let's look into Benjamin Graham's The Intelligent Investor. Because if you're looking to invest into a competitive market, you better know the rules that will skyrocket you towards success. But before that, please make sure to subscribe and like this video if you want to support us and be in the loop with the latest money tactics on how to increase your wealth. So let's get started. What is investment and how do you get your returns? Well, you must have heard about returns on investment. And this term holds real value if you want to succeed in this game in the long run. Finding passive sources of revenue is something the modern generation finds a real appeal in. Let's say you meet a person, and let's call him Mr. Investment. You've just decided that you want to play the investment game, and you quickly find a potentially reliable guy, Mr. Investment, who wants you to buy into his company. The deal looks too good to be true. He says you can make a lot more money out of what you invest into his company, also known as return on investment, and you are ready to give him your hard-earned dough. Now, wait a minute. Benjamin Graham would be really disappointed if you just gave your money to Mr. Investment like that. Have you really thought about it? When you invest money into a business, you obtain a percentage of ownership over that company. This value you obtain is only valuable as the amount that others are willing to pay for it, or the intrinsic value of the company, which is their assets minus their liabilities. To simplify, if you invested in General Motors, you would make far greater returns on investment in the long run if people believe that the value of General Motors would increase because of the assets they would purchase. So how do you gauge whether a company will make it or not? Well, Benjamin Graham has a simple solution to this. Only invest if you feel safe that a company is likely to last in the long run. This can be established using a few principles. The biggest of these being, what are the fundamental strengths of the company and what is in its balance sheet, or better understood as assets minus liabilities. See, the market is always fluctuating, and a company that is determined to sustain itself will present realistic valuations over its earnings. One other important factor Graham would ask you to remember is having faith in your investments. Fluctuating market prices are part of the investment game, and if you give in to emotions and sell a potentially valuable stock, you could lose out in the long run. Let's look at a real-life scenario to explain this. The world right now is facing a pandemic. The coronavirus has affected lives and businesses everywhere. Now, let's say you hold investments in real estate, a market that is usually stable and safe, but for now is facing a crisis, as people are unwilling to buy and sell properties. If you feel insecure and sell what could have been a really lucrative investment in a normal scenario, you risk losing out on a lot of financial income simply due to emotional weakness. And this is where Benjamin Graham would step in and warn you. If you invest your valuable income, only do so in stocks you have faith in. Why? Because economic recessions and economic booms are a mainstay in the investment game. Logic and economic calculations will always defeat emotional decision making, so your belief in what you buy is one of the utmost importance. However, Graham has two investment strategies you can use, depending on the kind of investor you are. Are you a defensive investor? If you are short on time and resources, or if you are unwilling to take risks because of your circumstances, this may be a great way to start your investment journey. Benjamin Graham advises you to invest into stocks and bonds on a 50-50 basis. to ensure that you never have to compromise your lifestyle or security due to investing. The first rule of the game is to do a thorough due diligence. If you find that they haven't paid out dividends over the last 20 years or that they faced excessive earning deficits within the last decade, these are warning signs to immediately back off. According to Graham, you should invest a limited but fixed amount of your income on a regular basis to make the maximum return. Also known as dollar cost averaging, this method is a safe strategy that beckons you to invest average prices when it comes to stocks and bonds. The second advice he would give you is to diversify your investment portfolio. Why? Well, because if you invest everything you have into one sector or one stock and it exponentially loses value, you are more likely to lose all of it and everything that you put towards it. Instead, the more potentially lucrative markets you invest in, the better your chances of finding sustainable and successful businesses that will bring you investment success. The third advice he would give this type of investor is to invest in an index fund, these being returns that weigh in an average of the market prices and provide a safety net for beginner investors. They essentially track a specific market and aggregate all those prices together. But wait, what if you're an enterprising investor? If you're willing to take risks and play with financial strategies, then the world of investments has a lot to offer you in return. The first piece of advice Graham would give to any enterprising investor is simple. You should only pay a finite amount of money. Don't invest more than you can afford, as you won't necessarily bring back the same returns. The first thing you should do is calculate a company's net working capital. You can do this by subtracting their total liabilities from their present assets. The enterprising investor needs far more time and willingness to learn than the defensive investor. So you would have to study financial records, reports, ask questions, and call up the company to ask for information you don't have access to. Obviously, only if they're public. In short, how willing are you to understand the ins and outs of the business you're investing in? Aside from the multitude of information this valuable investment handbook presents, one final takeaway to get you started on your journey is this. Rely on your calculations over current market trends and predictions. What the world says is valuable today may not be tomorrow. The investing game, according to Benjamin Graham, does not see a real-world application of risks and reward. Keeping this in mind, if you're a defensive investor, your key strategy would be to ensure the safety of your principal investment amount while bringing back returns that slowly grow your initial investment. For the enterprising investor, your main takeaway would be towards building a strategy that nets you steady, long-term returns, gauged through a complete understanding of the market and your willingness to stay with a stock until its time to shine arises. When it comes to investments and speculation, the market is ripe with possibilities. But when you play to win the investment game, the wins you make are almost always worth the investment you make. That's all I had for today. Thanks for sticking around, and I hope that this video, was able to help you understand, this insanely valuable book. If you liked the video, please hit the subscribe and like button at the bottom so you can stay updated about all the new content that comes up. Stay well, and see you in the next one.